Good afternoon, everyone. I'd like to welcome you to the special call meeting of the CERS Investment Committee. We have a relatively full agenda this afternoon, but I think it probably will move along fairly rapidly. Again, with the opening statement, and Eric, will you please present that, please, if you would?
Of course. This is a special meeting of the County Employees Retirement System Board of Trustees Investment Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and are not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. Connection cannot be reestablished within 30 minutes. The meeting will be adjourned and rescheduled to a later date.
Thank you, Eric. Sherry, would you please call the roll?
Yes, sir. Dr. Hackbart?
Here.
Mr. Cheatham?
Here.
Dr. Milkman? Mr. O'Mara?
Here.
And Ms. Pendergrass?
Here.
Thank you.
Are there any public comments, Sherry?
No, sir, no public comment today.
Thank you. We have the minutes. The minutes for the February 28th meeting have been distributed on the board book. Does anyone have any comments, suggestions, and changes to the February 28th minutes? If not, would someone please move to accept the minutes as presented?
I'll move they be accepted as presented.
Thank you. Is there a second, please?
Second.
Motion has been made and seconded to approve the February 28 minutes. All in favor, please signify by saying aye.
Aye.
Opposed? Motion passed. Thank you, everyone. First item on our agenda this afternoon is the Investment Office Quarterly Update. And Steve, would you please proceed with the update? Thank you so much.
Yeah, thank you, Dr. Hackbart. Dr. Hackbart had asked that we provide a very brief overview of markets and performance for the third quarter. Although it already seems like it's ancient history, we also will provide a brief update on April and May before we move on to the actionable items on the agenda. Sherry, page 7, please. Thank you. Growth assets had a very strong quarter on optimism. The Fed had successfully threaded the needle and arrested the inflation genie without inflicting too much damage on economic growth, and as optimism grew for the prospects of all things AI. Real GDP readings continued to be strong, printing 3.4% for the fourth quarter. Consumer spending remained the main driver, contributing more than 2% to growth. U.S. exceptionalism stayed intact, with U.S. public equities up almost 10% for the quarter. Nearly every sector was positive, with communication services and energy sectors producing the best performance. Small cap equities underperformed large cap, and a continuing theme, by 230 basis points during the quarter, while growth stocks generally outperformed value. Non-U.S. equities produced positive performance but failed to keep pace with their U.S. counterparts, returning just under 5%. Developed markets outperformed emerging markets as the European economy remained weak and consumers hesitant to spend, fewer exports, lower investment, all reflecting diminished economic demand. Specialty credit, high yield bonds, and levered loans all had a strong quarter, benefiting from higher rate environment and spread compression. The more traditional defensive markets were mixed for the quarter. Core fixed income was down almost 1% as yields rose across maturities and the curve steepened. The 10-year Treasury yield ended the quarter at 4.20%, up 32 basis points from the end of December. Real estate securities were little changed during the quarter, up slightly in the U.S. but down globally. Commodities results were positive for the quarter, with crude oil rising over 16% and reaching its highest price since late summer 2023. Conversely, natural gas prices moved lower during the quarter, down almost 30%, the second straight big down quarter in a row. For the quarter, gold was up 7% at over $2,200 an ounce. Page 32, please, Sherry. Thank you. For the quarter, the portfolios performed in line with expectations and modestly underperformed their benchmarks. The CERS and CERS hazardous pension portfolios performed well during the quarter with returns of 4.64% and 4.67% respectively. The insurance portfolios produced similar performance with the CERS portfolio returning 4.69% and the CERS hazardous portfolio returning 4.70%. For the quarter, the benchmark produced a return of 5.27%. Fiscal year to date performance has been strong for all of the portfolios, with returns ranging from 10.15% to 10.33% versus a benchmark return of 11.06%. The public equity portfolio was the best performing asset class for the quarter by a wide margin, producing a return of 8.22%, while real estate was the worst performing asset class, with the portfolio declining by 4.24%. I did want to highlight the significant underperformance of the private equity portfolio as highlighted on this page. As we can see, every other asset class for the quarter outperformed its benchmark, but the private equity portfolio continued to significantly underperform. As we previously discussed, the difference is primarily driven by the mismatch with that benchmark. We're using a public equity benchmark for the private equity portfolio, and while that's reasonable and appropriate over longer periods, especially over market cycles, it may and has resulted in significant tracking error over shorter time periods, especially in more volatile markets. Looking at the private equity market data that's provided by external data providers, performance for the last quarter varied pretty widely based on the underlying strategies and ranged from down about 2% to up a little over 2.5%. For the quarter, the CRS private equity portfolios returned between 1% and 2%, with the benchmark, which is the Russell 3000 plus 3%, lagged by a quarter, producing a return of over 12%. This difference accounted for 100 basis points of underperformance at the total portfolio level, or over 100% of the underperformance relative to the benchmark. Year to date, the mismatch has had a similar level of impact on relative performance, with the private equity portfolios underperforming their benchmark by over 10%. There are a number of alternatives for benchmarking private equity, as we've talked about in the past. All of them have benefits, drawbacks, and challenges, but we do believe it would be worthwhile to add that discussion as we look to update the investment policy statements. I'll pause there for any questions. That was a lot.
Have you been able to check whether our peers have chosen an alternative comparison or benchmark?
I'll let Wilshire add too. They probably have a little bit broader perspective, but there's a number. There's previously, prior to the current IPS, we had a short-term benchmark for private equity and for some other alternative asset classes or private asset classes, and a long-term. So one was used for less than 5 years and one was used for greater than 5 years. That has been adopted a lot in the pension world, and that was using the actual performance of the portfolio for shorter periods and something similar to this Russell plus 300 for longer periods of time. That's really a performance objective. The program, which, as we know, with private equity, performance comes over time. So we look at over a longer period, 5+ years. That's how we want that's the objective for that program to perform. There are a number of third-party benchmarks that are provided. As I mentioned, they have some benefits, some drawbacks, and some challenges with implementation. But we have seen a number of our peers adopt one of those private benchmarks as well. And Wilshire, feel free to jump in there as what you're seeing from your clients.
Yeah, I'd say similar. The clients we have, similar to you, other public pension plans are either using, for the most part, a benchmark like you're using, where you just have to accept the fact that in shorter time periods there's going to be potentially a lot of noise, or benchmarking to itself, which then doesn't tell you much when you look at your longer term periods. Right. So as Steve mentioned in the past, you used a combination of both, deciding which one rolls up into your total fund policy. We've simplified the report over the last few years. We used to show 3 or 4 different benchmarks for every different plan, and that was just a bit too complicated. So now that we've stripped out some of those benchmarks, you lose some of that color, but it has the benefit of, when you look at the benchmark, you don't have to worry about which time period is, which plan is they're all aligned now. So there is a benefit to that, and as Steve said, you have to accept a bit of a drawdown. You know, the academic literature will tell you that your benchmark should all be investable, and you can't go out and buy a fund that'll give you an index fund that'll give you Russell 3000 plus 3%. It'd be great if you could, but that does,
Lagged a quarter.
yeah, that does represent what you're hoping to achieve with the private equity program. We want a premium over public equity, so I think it makes sense as your long-term benchmark, and it's good that we remind everyone when we have these periods of extreme differences in the public and private valuations over a quarter or 1 year, just why we're seeing that noise, and reminder of what the trade-offs are if we were to benchmark it differently.
Steve, are you going to return to this when you in your next item, another item on the agenda, or should we expand the discussion here?
No, I think this is, I would table this discussion as part of the broader, so I know we're going to discuss the asset allocation as an agenda item, but I believe there's a more robust discussion going on about potential changes to the investment policy statement, which could include keeping this benchmark or potentially changing the benchmark. So that would be a worthwhile discussion at that time.
You'll be coming forth with a recommendation, at least not today, in the short term.
Not today. Yeah, I think that's in a broader discussion about some changes that we've identified that we think would be beneficial for the investment policy statement.
So I understood. I just wanted to clarify that.
Absolutely.
Ms. Pendergrass has her hand up.
Betty?
Yes, I'm looking at the private equity yields versus the public equity yields, and in the short-term time frame, 1 year or less, those returns are less than, or the private equity returns are less than public equity. Is that indicative of the evolution of our particular private equity funds? Are they moving into that lower section of the bell curve on those returns?
So yes, to some extent, I would say the difference between those returns is broadly a market impact as well. We've seen public equity markets have done some really very strong, over the past year, shorter period of time. As I mentioned, and if we look at some data provided by private equity benchmarking firms, performance for the quarter was we're in line. Our private equity portfolio is in line with what we see as the broader private equity market, being down anywhere between 2.5% to up 2.5%. And then we think about that market, that's a pretty broad market, and they slice and dice it several different ways as to the strategies of the funds. But there also is an element that the vintage for our private equity is obviously different than a broad market public or private equity benchmark. So that does play into our specific performance relative to the broader private equity market.
Steve, isn't there also an issue with that as far as the age of the valuation of public equity, or excuse me, private equity? You're relying on the valuations reported. Aren't they lag at least anywhere from 6 to 12 months?
Yes, so that's part of the reason for the lag with the public equity is the Russell 3000 plus 300 lagged a quarter. Most of our valuations are quarterly, so we'll see at the end of June we'll get valuations that are effective really as of the end of March, so 1 quarter lag. So there is a timing element to that as well, which we've tried to accommodate here with the lag component to the public equity one, but it's never perfect. There is misalignment. And again, as we all know, especially in private equity space, there's, really market valuations are at best estimations, right? We look at realizations, so the cycle of our investment, what's our MOIC, what are the realizations ultimately, prices can tend to fluctuate. We know there's tends to be a bit of a timing lag. There's a lot of academic literature on the timing lag of the pricing for private markets, especially for private equity. But the valuations we received are essentially on a quarter lag.
Any other questions? If not, Steve, did you have additional information about the first 2 months of this quarter?
I was going to provide a very brief update on April and May. And performance for April was recently finalized and distributed, and consistent with the softer markets that we saw. The portfolios were down between 2.25% and 2.3% for the month. Markets were able to rebound in May and recovered some of April's losses, but momentum began to fade towards the end of the month as bond yields reversed course and began to rise on fading expectations for rate cuts, which really generated valuation headwinds. For May, U.S. public equities were up almost 5%, again led by technology sector, but all segments of the market and capitalizations performed well. There was less dispersion than we've seen in recent months and quarters. Global equities were able to rally as well, but continued to underperform their U.S. counterparts. Fixed income and real assets also participated in the rally, with core fixed income up almost 2% as yields fell through the course of the month, and high yield bonds and leveraged loans were up 1% for the month. And broad commodities were up almost 2%, but oil was down nearly 6%. Performance for May is still very preliminary, but all the portfolios are indicated up about 2.5% for the month.
Over the entire period, Steve, how has specialty credit performed relative to public equity?
Well, as we see, if we go back to the chart here, we can see our specialty credit portfolio, over longer periods of time. We haven't had it in place as specialty credit for more than 5 years. But if we look at the 3-year number, our portfolio is almost 6.75% versus 6% for public equities. And now this is very cautionary there, as that time period, obviously that encompasses a lot of what was a very low interest rate. And again, specialty credit, whether it be high yield bonds, leveraged loans, or actually private credit, all have a significant yield component to them, whether they're SOFR based or the old LIBOR based for loans. So they have a loan component, which influences obviously performance and yields. So I think the prospective outlook for that asset class is for higher performance returns than what we have recently seen, just because of the base case effect. So the base rates that they're able to achieve in their lending.
There's a bit of a downturn in the third quarter, if I understood the data correct. Is that?
So for the third quarter of the fiscal year, we see that specialty credit outperformed the benchmark by about 65 basis points.
Right. Okay.
So it had a strong relative performance. And again, that's our portfolio and the composition of the benchmark. Our portfolio is roughly 50% private credit and 50% public high yield bonds, multi-sector, and leveraged loans.
Any other questions of Steve? If not, I think we can move on to the next item. And that's the discussion about potentially adjusting the benchmark. Would you proceed with that, Steve, please?
Sure. Sherry, I think that's page 115, please. So following a review of the public equity portfolio index structure, KPPA staff is recommending the investment committee approve a change in the benchmark index for the U.S. public equity large cap internally managed passive portfolio. I'm going to have Joe Gilbert go over the details, and then we'll be happy to answer any questions.
Good. Thank you.
Okay. Can you hear me all right?
Joe.
So as Steve suggested, that we're recommending that we make a change in the benchmark of that particular portfolio from the S&P 5 to the Russell 500. This recommendation, there's no placement agents or anything like that in connection with that. As a bit of background, while we do have a global equity target, we at one point had a U.S. equity and a non-U.S. equity target. So our portfolio is structured where we have a lot of those kind of, I'll use the term silo type of strategies that we use to build up that global allocation. So within what we would refer to as our domestic allocation, 70% of those assets are managed in-house by staff. Of that 70%, 90% is is this particular mandate we're talking about, the U.S. large cap. That's roughly about 35% of our global allocation, just to put it in size context for you. All the other assets within the domestic side of the portfolio are benchmarked to one of the Russell family indices. So we have a Russell 3000 growth, a 3000 value. There's a mid-cap Russell portfolio. There is the Russell 2000. There's a Russell microcap. And so where we have most of our strategies being Russell based or indexed against, and then we aggregate that with an S&P index, the potential arises for to have a market cap tilt that we might not have intended, in that the two indice providers use different methodologies to build their indices. They end up with a little bit breakpoints at those market caps that don't necessarily align perfectly. This has been something that's been within the portfolio for probably 8 or 10 years. It's not really ever caused us any issues because staff's aware of it and we account for that. And so we have considered making this change in the past, but to be honest, it was never a high nail. There was always something else, and that was a little bit more pressing at the time. And like I said, we're aware of the potential issue. We've been able to account for it. However, it has become a little bit of that nail has stuck up a little bit, in that our representative from Dow Jones, who provides that indice, contacted us and said they'd like to have a discussion about our relationship, which is code for we would like to increase pricing. And we got to that point pretty quickly. Historically, we've paid about $27,500 annually for access to that data. Because we manage in-house money against that, they viewed us as a money manager and wanted to start applying not only that flat fee, but also a variable fee that was attached to the amount of assets we ran against it. When you do that, that would increase our cost an additional $137,000 a year. So it would take that $27,000 line item up to about $165,000 annually. And so with that, I said, well, let's reconsider like moving to this Russell a little bit more aggressively now that they've put this on the table. So the two issues we've kind of discussed, by moving to Russell, clearly we would eliminate that potential market cap, unintended tilt potential that's there. At the same time, from a cost perspective, they are offering $30,000 flat annually to gain access to all their indices. So if later down the road there was a strategy we might find appealing, we could implement that without any additional cost. Clearly, we don't want to make a change just to save a few fee dollars if it's at the expense of performance. So we looked at our performance. The S&P 5 and the Russell 5, on any given year, there could be some deviation in performance, though from kind of in the midterm, call it the 5-year and beyond, that smooths away to basically no difference. And in the 10-year and beyond, the Russell 5 actually outperforms the S&P 5 by a handful of basis points. So performance is not really a concern. So we've solved our issues. We don't lose any performance. We want to make sure we weren't bringing any additional risk into the portfolio. So when you look at the volatility of the two indices from a standard deviation perspective, they basically sit on top of one another. So there's no concern from an additional risk coming into the portfolio from making this switch. So at this point, we said, okay, we've solved our potential issues. Performance remains consistent. We haven't introduced any additional risk into the portfolio. Can we get there inexpensively and fairly easily without having a massive transition event that's costly to the systems? The short answer is yes. Of those 500 names, they have roughly 440 names overlap, which sounds like, well, there's 60 names that are not in overlap. However, those 440 names account for over 97% of the index weight. So really, there's less than 3% of the index weight that those two indices don't share in common. We don't believe it would require any kind of large-scale transition event. It's something that we can kind of move into over the course of our regular rebalancing that we do, our quarterly rebalances. If there's some money to put to work or some money that needs to come out of the market, it can be done at those times. So it would not require any significant expense to make that transition occur. So in conclusion, we're recommending that we make that change. It makes the portfolio a little bit more consistent in the family of indices we use. It makes it a little easier to efficiently manage those market cap exposures. We maintain the existing fee structure, so eliminate that increase in fees. The performance we believe will remain consistent, no additional risk into the portfolio, and we believe we can get there relatively easily without any real cost to the system to make that switch. So with that, we're recommending that we do that. And so I believe it was decided that the committee would need to take a vote on that action.
So
Yeah, and I think thank you, Joe. I think that's a great summary. The priority here is alignment. I think the alignment, switching the indices is good, reduces potential for tracking error with the benefit of a lower cost. So all in, I think it's a good recommendation.
logic seems reasonable. Procedurally, what would you have to do? Just
It wouldn't require, like I said, we can do this as part of our normal rebalancing. So quarterly, we do a rebalance of the allocation. There would be some sales that would need to occur because there are names that the S&P 500 has that the Russell does not. At the same time, there would need to be a few purchases where the Russell has some names that the S&P 5 does not. Rather than doing that in a large event, for instance, if we needed cash for something and we decided to bring that allocation down a little bit, we could just sell some of those S&P 5 names and kind of slowly morph from one to the other. Like I said, while they only have the 440 names in common, that's 97% of the indice. So there's not going to be, while there is 60 names that would have to be turned over, it's not going to be turning over a very large portion of the portfolio. And we can do that slowly so that it is minimally impactful. So,
any questions, Joe or Steve?
Joe, just a quick question. I understand the transition that you're talking about. Do you have a timeline in mind to complete that transition?
The only, I guess, one of the caveats would be we would have to sign the agreement with Russell to get their data. So my guess is it's pretty standard with very limited wiggle room from go back and forth. So that would happen relatively quickly. From that point, we could, if we wanted just to get it done, we could do it in an afternoon with no issues. It could be done very quickly. So, but if we want to just kind of limp into it so as not to create a big event, we may do it over the course of one or two trades while Steve and I look at our allocations, or just June is a rebalance month for both of the indices. So we could kind of do it in alignment with that because we would be more than likely having a rebalance trade this month anyway. So we could kind of do it in lockstep with that and kind of not hide, but rather than having an additional trading event, it would just kind of be incorporated into that rebalance trade. So kind of minimize the amount of times we go in and out of the market.
So I'm hearing you say within 60 days.
Yes, we could definitely do that. So
assuming we can get the agreement signed.
Right, which
as Joe mentioned, there's always a caveat when we have to have legal documents reviewed and
assuming there's no issues with the legal doc, it can be done relatively quickly. Yes.
Any other clarifications or questions? I'm not sure we really need a vote on this, but I think it probably would be fine. If there are no additional questions, would someone basically move to accept the recommendation of staff regarding adjustments in terms of our benchmark for large cap public equity?
So moved.
Thank you. Is there a second, please?
I'll second.
We have a motion and a second. Any discussion? If not, all in favor, please signify by saying aye.
Aye.
Opposed? Motion carries. Thank you, both Joe and
Thank you
for your presentation.
Thank you.
I think that basically takes us to the last item on the agenda, which is further conversation and discussion and I guess technically a reconsideration of our asset allocation recommendation. We've been focusing on this possible adjustment to our asset allocation for the last couple of meetings, which I think is good to do. It's something normally we do every 4 or 5 years. We had a more recent adjustment in our asset allocation. I believe that was in 21, if I recall correctly. So we're on the short side of the typical adjustment in our asset allocation strategy or policy. But we have had considerable conversation, and basically, in sort of a nutshell, basically the adjustment involves reducing our target for public equity and increasing the target for especially credit. The other adjustments are relatively minor. I think in terms of real estate, certainly probably some concern about real estate performance, and maybe an adjustment there is appropriate. Also, other items, some marginal adjustments in terms of recommendation, but probably would be good to review that recommendation that's come from the staff and open the floor for additional discussion about this, which is a fairly major responsibility for our committee, and the possibility of returning either this recommendation or an adjusted recommendation back to the full CERS board at its future meeting. So, Steve, would you want to lead the conversation? I understand that we also have with us Wilshire staff as well for clarification if questions arise. But if you would proceed, I think we share some ideas or thoughts that you might fill us in on. For example, if we were to make these adjustments, what would be the process? And I know we've talked about that briefly before, but I think it would be beneficial to for you to share your thoughts in terms of if we were to reduce our target for public equity, what would be the steps going forward in that regard? Another question I think that has appeared in our conversation that would benefit from some additional clarification is the whole issue of liquidity on the specialty credit, whether or not there is actually a cash flow that we would receive into the fund to supplement our other assets coming into the fund, or whether or not that would be predetermined by contract or how that would be determined, or if, in effect, if certain credits are completed, that whether those funds would simply be reloaned by those fund managers and so forth. So maybe focus a little bit more on the process, I think would be very important to help us fully understand what's being proposed and what procedures would be necessary to adjust our asset allocation if we choose to do so.
Sure. Happy to do that, and I appreciate the opportunity, Dr. Hackbart. And I would comment that you're absolutely right. I think the idea of a full asset liability or an asset allocation work, it's not something that's undertaken lightly. It's not something we don't want to make material shifts, swings in allocations, on a year-to-year basis even. But we really felt that with this instance, it was warranted primarily due to, as we've talked about, the regime shift, the material changes in both existing markets as well as capital market assumptions. And that's the work that we requested Wilshire update their capital market assumptions. The prior modeling had used June 30 of 23. They updated to the end of March 24. So the most current capital market assumptions that they had available. And the output here, they reworked their models, their optimizations, given the asset level or asset class constraints that we had imposed. Again, part of that is to put some guardrails on. We don't want material changes. As we've talked about, an unconstrained model running with current capital market assumptions would produce the optimal or optimized portfolios that are vastly different from even what you see as from the recommendations here. Kind of given the all-time lows and equity risk premiums, you would see an optimized portfolio unconstrained that had a very low, if any, allocation to public equities. That's obviously not our view, not what we're interested in, and we're not making significant or drastic changes of that magnitude. But given the changes in current market as well as the outlook, we thought it was warranted to visit our asset allocation and see ultimately with the goal of, is the market affording us an opportunity to reduce the overall expected risk of the portfolios while maintaining the expected levels of return. And we think that's exactly what's occurring now. And again, the biggest drivers of that are the significant rise in yields and any investment with a yield component, whether it be core, whether it be high yield, and diversify away from growth assets, which are primarily the largest constituent for us is the public equities. We have, again, the all-time lows on equity risk premiums. Some of that is the argument that we've seen a pull forward of returns. So performance for public equities has been so strong that's pulled forward some of that performance that we expect to occur, over a 10-year type horizon. So, the expectations looking forward for public equities are certainly more muted than they were 3 years ago. And quite frankly, more muted than they were from the 6/30/23 capital market assumptions. That's been one of the most significant changes. Public equity expected returns have fallen from 6.15% to 5.10%. All of that really leads us to this recommendation that we are making, as well as Wilshire, that we take this opportunity that the market's affording us to de-risk the portfolios at the similar level of expected return. We talked about liquidity, and liquidity obviously is always forefront for us. The funds are currently in a net cash flow. They're experiencing net cash outflows, and that's both experience as well as expectations. So we have a keen focus on liquidity profile, and the recommended portfolios and allocations not only reduce the total amount invested in what are illiquid assets, but also increase the stress liquidity profile of the portfolio. So really puts the portfolios in a better liquidity position, and it also increases the cash yield of the portfolios. From a peer perspective, CERS liquidity needs remain relatively modest, I think. And that's especially as we look at more mature plans, there becomes a need to use income generated by the investments or the investments themselves to fund the gap between contributions and distributions. And this increase in cash yield helps to meet that. We believe that this recommended allocation provides substantial flexibility and regular available cash flow from distributions to minimize the probability of substantial forced liquidation of any asset class. So that's something we manage on an ongoing basis. And again, that increase in that cash yield, it gives us more flexibility with liquidity available to the portfolio. So we're not liquidating assets in the event that there's a liquidity need or a change in circumstances as far as the net cash flow experience of the funds. If we look at where the portfolios currently are relative to this new recommendation, as we've talked about, it's not as significant of a change to the actual allocation as compared to what we have as the target allocation. So for instance, if we look at that specialty credit bucket, while the current target in the IPS is 10%, the actual current allocation, is a little over 9.5% across the pension portfolios. So if we're looking at increasing from a 10% target to a 23% target in that lower risk A, it's not really an increase in actual investments of 13%. It's an increase potentially on the target of more 4.5%. For public equities right now, we have a current target of 50%. Current exposure is more 52.5. That's obviously changing day to day based on markets. We're swinging a handful of basis points a day on that exposure. But we would expect, and as you mentioned, the changes to the other asset classes are less material from a target perspective, and we would expect implementation. It's not something we would, similar to Joe's index change, if we were to adopt and the board would ratify lower risk A, which is a reduction in target from 50 to 45 for public equities. I would expect that to occur over several months. I think we're very opportunistic. We're currently doing that for the KERS portfolios and the SPRS portfolios. They adopted a lower allocation target for public equities. And we're doing it in a stepwise manner. As we see opportunities, typically as we see strength in markets, we want to sell into strength, we want to buy into weakness. So as we see opportunities or our outlooks or views change, we certainly want to operate within that range with an eye towards our target and moving towards that target over time, unless we're implementing a tactical view. So from a strategic standpoint, I would expect, depending on the timing, it would take several months to move our target from where our current exposure, our current allocation to public equities down closer towards if we were to adopt the new targets, that would take a period of time. As we've seen with the private asset classes, whether that be real estate, real asset, those allocations, they have a longer runway. As we've seen, especially the most recent mandates we've onboarded have been in that real asset class, and some fund more quickly. It takes time to source. It takes time to get approvals, do our due diligence, work through the legal docs. Then once we commit the capital, for the managers to call the capital, as we've talked about, we're very supportive of a conservative nature of our managers, to really not be in a rush to deploy capital, to be opportunistic in doing so and doing it at the right time. So that harder to gauge on changes on the increases in any private asset class, but that can take a couple of quarters to fully implement and for the capital to get called. One of the managers we approved last year is still yet to call capital. We're anticipating here by the end of this calendar year that some part of our capital will be called. They have a couple opportunities, but they've been very selective in taking those, which we're supportive of. From the standpoint of, we specifically did an education session as well as a board session on that specialty credit. And when we talk about specialty credit, I think we really have to make the distinction. Again, about half of our exposure, and that changes over time, hasn't changed materially, but anywhere from 40 to 60% could be in public space, and 40 to 60% could be in the private space, if we kind of make that distinction. The public side is extremely liquid. It's as liquid as any other market, right? I mean, during times of distress, liquidity tends to evaporate, whether it's U.S. Treasuries, which used to be thought of as the most liquid market in the world. The bid offer or even the appetite can diminish significantly. As we know, correlations can tend to go to one in periods of high stress. But they are very liquid in that we can sell those assets and receive proceeds in a matter of days. For the private side, or the private debts, private credit side, which is again roughly 40 to 60% of that overall allocation, those are different from the lockups we typically see in private equity. One, they have a much shorter investment period and harvest period, so they started to harvest much more quickly. And even in the investment period, we're receiving distributions. It is an agreement by agreement basis. Most of our agreements, we elect to reinvest those distributions to maintain our exposures, but we can certainly change that. And if we needed both, we can receive distributions, and the distributions can be on the magnitude of more than the yield of stocks, certainly somewhere in the 5 to 10% kind of realization of distributions, not including when we start to harvest. So when we harvest investments, and again, they make a loan, the loan repays, that loan is harvested, that distribution comes back to investors. Whether it gets reinvested or not, so the capital gets recalled, can be dependent on both the agreement as well as the reinvestment period. Once the reinvestment period is expired, those distributions come back to us and they're not reinvested. So we get that in cash, we have to allocate it somewhere else. But it tends to be a significantly higher cash flowing investment, certainly than what we see in private equity. So while it's categorized as illiquid, and certainly in the calculations that Wilshire does, it's considered illiquid because there's not a day-to-day market for them. There is cash flow. There is the option to elect distributions, so we can manage exposures and liquidity within those investments.
So you can elect for distributions when you go into these, when you invest with.
Yeah, and we can request distributions. So once we're outside of, we have some evergreen structures as well. So they're we can elect to start receiving. There's restrictions on how much, right? Like in each document governs how much can you elect 20% of your investment to be distributed, and then they have a distribution period when that money comes back to you. But all of those investments include some mechanism for receiving distributions. Yes.
So Steve, could we change the target for specialty credit without materially and be in alignment with the target at roughly 20%, without adjusting downward our allocation to public equity?
Could we maybe rephrase that? Apologies.
Say, right, we're about 23% in specialty credit, which is
we're about 20. We're a little under 20%. A little under 20% right now.
Above our goal of our current target of 10%.
Correct.
They're currently, could we just simply change the target for specialty credit to 20% and leave public equity at 50%? Being we're already, that's sort of what we're doing right now.
I mean, that's certainly something the investment committee and board could do. I think the recommendation, and Wilshire can jump in here as well, but a key tenet of the recommendation is that reduction in the target for public equities is one of the key linchpins of what is reducing the risk of these portfolios.
If we're reducing public equity and we're already 20%, roughly 20% for specialty credit, where would that 5% flow? Would it flow to real estate, fixed income? Being we couldn't really be adding theoretically to specialty credit because we're already at the target.
Well, the recommended target for specialty credit would be 23%. That's I think the lower risk A portfolio was the portfolio that was originally approved by the investment committee and sent to the board, and that has the higher public equities of 45 relative to the lower risk B, which has a 40% target. So if we look at that, I mean, from a target only perspective, that means 7% comes out of public equities. That 7 of it goes into specialty credit, and this is just not from an actual exposure, but from a target perspective. And then 2 goes into cash, and then we have reduction in real asset, we have a reduction in real estate, and those go into specialty credit as well. From an actual allocation perspective relative to where we currently are, so we would be 7.5% overweight public equities. We would be roughly 3.5% underweight specialty credit from an actual. So that would be a natural. We could shift that part of that 7.5. The other, the 4% that from a target perspective relative to actual that would come out of public equities ultimately. That goes back into where we're underweight. We're significantly underweight real return still. The recommended portfolio lowers that, but we would still need to add. And part of that, again, we've shown that pro forma relative to actual on our allocations. Pro forma just means we've committed capital to a number of managers in that real return space, and that hasn't been called yet. So when that does get called, we'll have to source that capital. Currently, what we've been doing is we've been holding it in the specialty credit, again, given as a proxy asset, given our view of a similar risk return. And if the asset allocation stayed the same, we would be bringing down specialty credit as we ramped up real return.
Just to jump in real quick and maybe answer Dr. Hackworth's question. if we were to take the specialty credit to 20%, realizing it's not a perfect modeling, the far right-hand side on lower risk B, you can see that it actually prefers core fixed income as the alternative asset class, which is what I think Dr. Hackbert was asking, where would that money go to? And a lot of that goes back to slide 8, where we look at our capital market assumptions, where if we just look at US markets right now, our US equity market assumption is actually now below our core fixed income assumption. For the first time in our history, we have a negative equity return risk premium. And to Steve's point, where we've seen so much of that kind of forward-looking return brought forward, that's what's driving that forward-looking assumption lower. So we have just right at a 4.5% U.S. equity return assumption, where our core bonds in U.S. equity are at 5.05. So that's why you see the optimizer liking the core fixed income. And it's really driven by what we put the floor, which is a risk tolerant decision that the IC needs to make for the overall portfolio. If we set that to 40, it ultimately drives more of that that additional 3% that we take out of specialty credit into that core fixed income.
Yeah, as you'll see on page 126, I believe, Sherry, that the dark columns, the gray columns, are the constraints that were implemented for the modeling purposes. And exactly to Chris's point, if you implement a floor or a minimum for the model of 45% in public equities, the result is a portfolio, an optimized portfolio with 45%. If you lower that constraint to a floor of 40%, it's going to give you the lowest possible allocation of 40%. Again, we talk about it in theory. If you were to take all of those constraints off and just say, let the model run unconstrained, an optimized portfolio is going to have a close to 0% allocation to public equities. Again, going back to that all-time low negative equity risk premium, it just prefers other asset classes on a risk-adjusted basis, certainly.
And lower risk A, which was a similar expected return when we presented this late last year, now actually has a higher expected return with a lower risk level because of that negative equity risk premium.
And Mr. Cheatham has his hand raised.
Yeah, thank you. I wanted to touch on just a couple of things. First off, with regard to the assumptions, I'm assuming, might be a big assumption on my end, when we set our targets, whether we're talking about a current target, for example, of public equity at 50%, and under lower risk A at 45%, and you can go through all the different asset classes, those would be our neutral weightings, is the way I view it. Is that correct?
Yes.
So, along the way from year to year or cycle to cycle, ever how you want to term it, you're going to have opportunities that arise. I like to call them fat pitches sometimes. If I'm looking at our allocation right now, we've certainly had a nice run the last 12, 14, 15, 16 months, which has pushed our current public equity allocation above our neutral target of 50%. We're at 53. So part of what I'm looking at here tells me, we need to take some of those winnings off the table and reallocate those to what we consider to be the next fat pitch, which I certainly agree specialty credit would be tops on my list based on what I'm seeing. But if we go with the lower risk A and we adjust that public equity number to 45, that puts us at 7% overweighted based on our neutral weighting. I'm seeing just a slight underweight on private equity. I'm seeing a 3% underweight on specialty credit. Everything else is in line until you get down to real return, which I think, Steve, you indicated could solve itself by just having capital calls. Is that correct?
Correct.
So we're really only making, we're making out of the 7% potential adjustment to get to a neutral weighting, 3% of that to me ought to be on the board anyway if we kept our allocation the same. It's the other 4% that we're dealing with that needs to be reallocated. I honestly don't know that I see that this is a significant change whatsoever, particularly given our tendency to allow a range around that neutral weighting going forward. So I just wanted to point out that we're really only talking about, really technically, as far as I'm concerned, reallocating of about 4%, not 7% in public equity. But I wanted to go back, Steve, and get clarification. And Wilshire, you guys please chime in. If our typical weighting to specialty credit is approximately 50% high yield and the other 50% private equity, or excuse me, private credit, going back to your liquidity issue, on that private credit, Steve, Wilshire, what is our average duration on that debt?
Most of that debt is very short because it's loans. And both from an instrument standpoint as well as the investment period. If we look at more of the portfolio and less of the individual loans tend to be very short duration, right?
I understand. I want to hear a number. That's what I'm looking for, is a number.
Inside two.
Okay, that's the point I was trying to make. So going back to my earlier point of being kind of the current fat pitch out there, which you don't get these opportunities very often where you get a really good return, not lower risk, and not having to lock those dollars up for 5 and 10 and 15 years. In all reality, we're probably going to be back looking at our private or specialty credit allocation again, probably within the next 2 to 3 year cycle, correct? Wouldn't that be all?
That's correct.
Okay. You made a statement with regard to yield. What are you seeing currently is the average yield, particularly not on the public high yield debt, but on the private credit debt?
So broad strokes, we're seeing low to mid doubles. So low teens to higher. Obviously there's a risk spectrum there, but we tend to be more conservative. I view our private credit allocation has tended to be more conservative, and we're still seeing, again, low teens to mid teens.
Okay, so let's just go conservative. We're talking about a dividend yield on the low end of 9 to 10, on an upper end around 12. Fair to say?
Very conservative, yes.
Okay.
Is that net of fees?
Yes. Yes, that would be net. Again, most of our, we've talked about fees in the past. We've negotiated really good fees, I feel, in the specialty credit space on the private debt side. Management fees are very low, I think, on a relative basis, and part of that is we have shifted towards more co-investment as well, which comes obviously at a no fee basis. So all that's net. We look at what our net yields are in that space when we're investing.
And to piggyback off of Lyle's analogy there, it's partially about watching a ball sail by too every now and then, and not just looking for fat pitches. And that's why cash and core fixed income seem attractive right now. And to your point about how we don't typically do these every couple of years, and it's only been a few years, that's usually because we don't see the magnitude of capital market assumption changes that we've seen. So the background materials have a bit of that history, and
sure.
Part of the reason to cut core fixed income and move more into equities is because core fixed income wasn't offering really any utility. So it wasn't worth taking a ball most of the pitches were good to swing at. Now you can put that defensive aspect of your portfolio back. That's why we see even in lower risk A that cash has a place in the portfolio, and you already have some cash in the portfolio because of your operational needs. Now it's even garnering a target in the optimization, which would mean that it would diminish some of the drag you have against your benchmark by holding that transactional cash.
One last point. This is to correct the rest of the folks from Wilshire. Seems like I noticed a note in your all's material. Current default rates within the private credit as well as the high yield bond market is running about half what the normal is. Is that correct? At less than 2%?
I'm not exactly sure which note is that part of our market background slides. I'm sure if that's what you saw on the slides, then yes.
That's accurate.
Okay. But historically, that average has been just a little bit above 3, correct?
Close to double, yeah. Again, the changes in market always make apples to apples comparison, you know, a little more difficult. But historically, yeah, that's a fair assessment.
That's a good indicator of where these businesses are.
Yeah, it certainly is. I think the health of a lot of those businesses has improved substantially.
Yeah. Well, I from my perspective, you know, I have a hard time, you know, looking past that nice healthy dividend yield and a low default rate as being a real key to this adjustment. So that I think I'm done for a little bit.
And Lyle, you are correct. It was just right around 1.75% roughly on the default rate versus 3% historical over the past 12 months.
Do you have similar data for economic downturns? And we've got a very strong economy. We expect defaults would be very low, but what about the longer term?
I don't have those on the top of my head, but I'll be happy to get back to you with some of those numbers.
It's not we've seen high single-digit defaults, certainly. You know, when we start to get in stressed environments, I think part of you know, the focus also shouldn't solely be on default rates, but I think losses given default. So that's what we really focus on is not just is it going to default, but what is our loss if it were to default? And part of that has to do with the protections we have, where we are in the capital structure, you know, what's in front of us, and really those recoveries. And that's one of the reasons in our private credit portfolio we've tended to be a little more conservative, both from a term perspective as well as where we're lending. Greater protection. So it's not, even in the event of a default, there are certainly cases where we may not lose capital or significant capital, even in the event of default. I just want to focus both those. Sorry.
I'm sorry. Most of these are just in the capital structure of a collateralized loan with 50 better equity, correct?
Yes, yeah, very LTVs, and then we do a lot of it asset backed or something that's collateralized by hard assets or cash flows or a number of different structural elements that offer significant protection in our view.
Other questions or comments?
I have a few comments. There are several concerns that I have about increasing allocations to alternative assets and specialty credit. It seems to me that 36% of our portfolio on alternative assets seems like it's high enough to achieve the diversification that we might want to put. In earlier years, we had a table that showed us a progressive scale of low liquidity to high liquidity returns and risk, and specialty credit seemed to be in the middle of that risk analysis on that particular table. I've got a copy of that schedule that was discussed in earlier investment discussions at the KRS board. The management fees, I understand that we've probably negotiated some good returns, but almost 68% of our management fees are paid for less than 20% of the portfolio. And that's the relationship that bothers me, is that if you look at the, I think it was on page, no, the page 29. Nope. Well, page 29 shows you the difference in the U.S. equity yield versus the high yield. Steve, the page in your quarterly update that has the schedule of the March 31st quarterly report.
Are you looking at the fee information? There's one on page 85. I'm not sure.
No, I was looking, it's on page, let's try page 32. When I look at he talked earlier about the fact that the specialty credit has only been on the books for about 5 years. So if we go to the 5-year column, public equity over that 5-year period has generated 10.61, while specialty credit has generated 6.54. And this schedule is net of fees. I'm concerned that some of the schedules in the Wilshire report projecting returns are gross and not net.
The specialty credit, we pay about 50 basis points in fees on average, in management fees.
When I looked at the March 31st reports and calculated some percentages, it was more like 190 basis points.
If you include, you include performance fees, which performance fees typically, even in the worst case, are 80-20, right? So we're getting 80% of that. You want to, I'll always say, you want your performance fees to be as high as possible. So if we
well, I'm looking at what comes out of the trust. And what comes out
that doesn't come out of the trust.
Points.
That doesn't come out of the trust. That was never ours. They earn, we get 80% of what they earn, what our investments earn.
Okay.
So I think that's it's a distinction that's important. Obviously, we work hard on minimizing the fees that we pay, but there are certain asset classes where, especially where there's a performance associated fee, that depending on the structure, and again, the most egregious are going to be something in the order of 80-20, right? So if we make $100 million, the investments make $100 million, we get to keep 80 million, but we have to pay 20 million in fees. It's a lot better than the investments making 10 million. We get to keep 8 and they keep 2, or we get to keep all of it. We get 10, 8 times as much. I'd rather pay that higher performance fee. And as we've talked about in prior ones, we didn't touch on this one. There's also that element that's the miscellaneous fees and expenses, which get aggregated, I think, erroneously into fee information on this report. That really, most of that is credit facility related, in that the credit facilities, obviously with the significant rise in short-term rates, any asset class that relies on a credit facility, a borrowing facility for investment purposes, has seen a substantial rise in those fees. But again, the offset to that is that's the yield that we're getting, right? I mean, the fees, looking at it only in a single dimension, I think can be a little bit misleading. It looks like you're paying a high fees, but when a credit facility is deployed or utilized, we get something on top of that. So that means that if they pay those fees, our yield is in excess of that. So that is part of performance that comes back to us. So I would agree on the exactly to your point, looking at that performance, the performance page, specialty credit. Now, specialty credit is only because it got aggregated. It used to be distinct, right? We used to have global bonds, we used to have high yield and specialty credit. That we didn't have private credit at one point in time. So that short-term time period, but comparing public equity over the 5-year period to specialty credit over a 5-year period, I think it's important to recognize what part of the cycle we've been in. And again, for a substantial part of that cycle, interest rates were near zero, right? We were in a ZIRP world where you couldn't, I remember we were investing in short-term instruments for a handful of basis points, 3 to 5 basis points is what we were getting. With the rise in rates and the outlook for rates to remain elevated, maybe not at current levels, but certainly not going back to zero in our view anytime soon. There's a period here where we're able to invest in take advantage of those higher rates. So I think we always have to look at how asset classes have been done. We look at that on a continuous basis with our allocation, but we tend to want to look, prospectively, what's our expectations for those asset classes going forward. In high yield, which is generic, one of the best indicators of 5-year out performance is current yield. Same with core, right? If you want to tell me how core is going to perform over the next 5 years, let me know what the current yield is on that portfolio. That's a good estimate of where the performance is going to be. And right now we're fortunate in that we have a time where it's really, really high, at least relative to pretty broad recent history. So that's the opportunity, is that yes, maybe on one asset class compared to another asset class over any specific time period may show well or may not show as well. But when we look forward, given our current starting point, where do we see opportunity? Where do we see the best investment of the next dollar? And we look at that on a net basis. We always view what are the fee impact. If we're getting a 10% return, but it's costing us 5% in fees, that's not real attractive to me. If we're getting a 12% return and paying 50 basis points in management and 20 basis points of above a hurdle and upside, that becomes pretty attractive to me. So that's kind of the case we make for why we think this recommended allocation going forward is going to be the best utilization. It's the most optimal utilization of our capital. It'll be the best for the systems, the best possible outcomes from a performance perspective.
If I could just jump in with a couple of extra comments, not to belabor the issue, but in looking at the fees that Ms. Pendergrass was talking about, you also have to realize a good portion of that public equity where you're not paying as high of fees is being managed internally, and getting access to passive management is significantly cheaper than active management costs. And active management is really how you're going to implement a lot of these, what you're calling the alternatives, the private equity, private lending, et cetera, et cetera. That's all going to be totally 100% active management, because there is not a quote unquote beta to be had there like there is in public equity. And to go back to the Wilshire assumption point, I will point out that those are completely beta assumptions. So we're not assuming any active management return added on to those assumptions that you're seeing on slide 8. Those are all beta assumptions. So when we look at private credit, we're looking at, let's just call it 8.25%, compared to what Steve was talking about a little bit earlier in that 9 to 12%. That's assuming the value add that you're actually paying your active managers there.
Other points, other questions? I guess one concern I had question in my mind, I guess, is again in terms of the projections, which a lot of this is based upon. you know, we've talked about this in previous meetings. We've been looking for a recession for the last 2 years. And we still have a very strong economy, and a lot of the fiscal policy is certainly part of that. And I think certainly we can look forward to a strong economy in the next 2 or 3 years, because we still have the stimulus of the infrastructure bill. The public equity has done very well, even with higher interest rates. And it seems that there's a possibility that as interest rates are reduced, that would be certainly a positive factor in public equity. And I'm just not sure why we're so concerned about public equity, or are we concerned about public equity and the projections that it's going to be stable, that the returns on public equity is going to be less than specialty credit. I guess I still have not been convinced of that in terms of any logic that would support the assumption that the economy is going to turn down when we've experienced a period where it appears our economy is strong enough to sustain higher interest rates. And I'm not sure that I've heard an argument would suggest otherwise.
I think part of a distinction we would make is that if you're asking us to predict something over what's going to happen 6 months, year, 2 years,
Or
that's
longer,
tough.
potentially
But-
longer. I
but
mean,
when we
we're not
look out
talking
to-
just 6 months.
Right, but we
We're
look at
talking-
periods like 10
Because
years.
we're talking 30 years here in terms of what our asset allocation.
Right. And when we look out over those longer periods, and we look at current earnings versus interest rates, there's a slide that isn't included in this deck, but it's in some of our quarterly materials that say if you would look at the historical relationship between equity multiples and interest rates, we're somewhere in the neighborhood of 40% overvalued in equity markets now. That given interest rates, given earnings, we're not predicting a 40% downturn. Some combination of falling rates and rising earnings could mitigate that. But you would have to see continued really strong earnings from companies, which is harder in a higher interest rate environment. If you're saying that we can sustain that interest rate environment, it just becomes harder and harder. They might be able to sustain a relatively stable economy, but growth becomes more and more expensive, which is why we've seen some of these high-flying tech stocks really swayed by interest rates in the last few years, because it's a really important input factor to their success. So we're not trying to predict a downturn in any certain period, but given where we are today, if we look forward over the next decade, to go back to the analogy that I tacked onto the end of Lyle's, is that we think it's a good time to take some pitches, watch a ball or two outside and low, and we're not talking about a wholesale departure from public equity. 50 to 45% we believe is an incremental step to reflect the fact that equity on the back of, I think we just came off of 2 quarters in a row of double-digit returns. As we put in this deck, the 3 quarters leading up to the assumptions that were in the original presentation, U.S. equity was up 19%. In the 3 quarters between that and the update we just produced, public equity was up another 19%. So coming off the back of 19 tacked on to 19 really drives home the point that some reduction in risk makes sense without no one's advocating that we step to the sidelines and say we're going to wait for, it's not like we're stepping to the side and saying we're going to wait for 40% pullback because that's what we think is fair value. We just want to lean in that direction a bit. And then to echo some of the points about the fact that you have ranges around these targets, in 2020, when the fat pitch showed up and equity sold off aggressively, that's when you can use your ranges to step in without having to go through committee and approve a new target. If your target's 45, you're going to have some range, probably 50-55% easily within range, that you could ratchet up to quickly if that fat pitch does materialize. And if equity markets continue to just plow higher, you've still got 45% target. We think that the portfolio will gain immensely from that, but will be a bit more diversified in case of some of these other potential adverse outcomes.
Yes.
Thank you, Dr. Hackbart. You mentioned just a bit earlier that you weren't convinced about the projection. And I wanted to speak to that as you and I have had conversations about our actuary actually looking at the 10-year projections of 10 investment consultants. So Wilshire, 2 years back when our actuary looked at the 10-year projection, was right in the middle of those 10 investment consultants. This year, Wilshire again is right in the middle of those 10 investment consultants that our actuary has looked at to determine what they perceive would be what goes forward. The other thing that I would say, if just given one additional opportunity, is when this was first modeled, it was modeled off 6/30/23 data. And again, we were able to reduce the risk in their portfolio with lower risk A, at the same time that we had the same portfolio return. And one could have argued then that it's all projection, it's all speculation. But we've updated that now with 3/31/24 data. So we have almost a full year of additional data, and what that's showing us is that there is a negative equity return for public equity today. And so it's moving in a direction that the committee and the board, and you guys have done a tremendous job in looking at all sides of the issue. But again, we have some actual data from the 6/30 to the 3/31, and the public equity return is lower than it was in 6/30.
Any other comments or questions? Well, I think we've had a good discourse about this recommendation, even though it may be a little sooner than we normally would make a change in our asset allocation policy, which I think probably has been one of the reasons why we've maybe spent more time than we would normally do in terms of trying to really understand the implications of any adjustments, both currently as well as into the future, which of course is a major responsibility that we bear. So I think we've taken this seriously. We appreciate all the information provided by Wilshire, our consultant. I know our staff has worked hard on this issue. And basically, I think one of the issues that we've had to deal with is the fact that, especially credit in terms of our current target, is now out of line with where we are. So that's an adjustment which I think becomes part of this whole process. Beyond that, the adjustments we're making are based upon our analysis of a variety of sets of information, ideas, opinions, recommendations, and so forth. So ultimately, it's our responsibility to decide whether or not we want to make an allocation change at this point in time, or if we want to go through a longer normal cycle. And I think that's the real question, whether if as suggested, maybe there are special opportunities because special conditions might have changed, which might suggest that we may want to make a change at this time period as opposed to the more normal time period if we would suggest that that's the case. So I guess our next step would be to seek a motion to decide whether or not we're going to recommend back to the full C board adjustment in our asset allocation, either based upon the recommendation that's on the table or even a possibility of a modification of that recommendation at the margin if someone feels that that would be an appropriate response. I think all those opportunities are available, either not to change our asset allocation, to accept the recommendation that's on the table, or a recommendation that's on the table with some modifications. Those are all options for us to consider before we take a vote or to make a decision about what we're going to recommend to the full C-Board. So with that, any other final conversations, comments, Steve or our consultant, or from our committee members?
Appreciate the time and the discussion. So,
Okay. With that, given those three possibilities, if that seems appropriate, was anyone moved to move a motion in one of those directions?
Mr. Cheatham, I believe you're on mute.
Sorry about that. Bill, were you getting ready to say something?
I was just trying to tell you you were muted.
I see.
Okay. Dr. Hackberg, what I was attempting to say at this stage, since we've batted this thing back and forth between the committee and the full board, what seems to me like the most logical thing is that we just send it back to the full board for the full board to hear the discussion and make the decision without, forcing their hand one way or the other. I think, like I said, I think, in my opinion, I'm 100% in support of lower risk A. I think the market that we're in right now for the foreseeable future, as far as the cycle, puts us in a position to take advantage of better return and lower risk. But I think it's something that the full board needs to hear and make the decision on.
My only objection to that strategy is that we did that a couple of months ago. And this committee came to that same conclusion, that they wanted the full board to express their preference. So we went to the full board, and the full board sent it back to the committee.
Well, actually, the committee made a recommendation and sent it to the full board, and the full board had discussion on it and sent it back to committee. I think that's when Wilshire went back and updated their numbers based on more current asset assumptions, which in my mind, even more so, points us in the direction of lower risk A.
Are you suggesting that there can be a vote to move it to the full committee without recommendation?
No, at a minimum, I think that's what
pass recommendation.
My recommendation is lower risk A, or whatever, but I think it's something that we need to make a decision on. We're getting ready to go into a new fiscal year. I know the investment office wants to get some guidance and start moving in one direction or the other. Because if we don't make any adjustments, we're certainly going to be making adjustments otherwise to get in compliance. So it's like I tell my clients sometimes no decision is a decision, so right now I think we're kind of at a point that we need to either move forward or,
I think I get a sense that if we do not make a change in our asset allocation overall, that there would be a need to reduce our commitment to specialty credit, because we are out of compliance with our current policy. Unless
Correct.
we made an adjustment to accommodate that.
Well, and, you know, to get in compliance, yeah, we would have to go, if I'm looking at the numbers correctly, we would have to cut our specialty credit by half,
Right.
given where we
Right.
stand. We'd have to cut our public equity by 3%, and probably raise our exposure in some places that I don't know that that's what we want to do. We would have to raise our exposure into real return and real estate, which that's a whole different discussion.
Right. That's for sure. Right. Bill, you have your hand up.
Yes. I've been listening, and there is a tsunami of recommendation from the professionals for lower risk A. But there was also a comment that core fixed income is maybe the slow pitch right now. And so, you know, I would rather, instead of increasing specialty credit 3% more, increase the core fixed income. But if I understand the numbers right, that will decrease the expected return with that adjustment, which is below our 6.5% stated goal.
I assume it's.
So,
Yeah, go ahead.
go ahead.
No, go ahead, Bill. Yeah.
Well, I also agree with Betty that we as a committee need to make a decision to put forward to the full board. We either, as you pointed out, do one of three things: pass, adopt A, or go with an adjustment. So I'm in favor of having some forward motion by the committee today.
Bill, just to your point, you can see the lower risk B, which does take specialty credit to 20 instead of 23, has some other changes in it as well, but you can see the returns for those two portfolios are 6.43 and 6.4%, so relatively minor, and to your point, both falling below 6.5, but as a reminder, these are the, call them the beta return assumptions. So this is, if you just set your asset allocation to these numbers and did nothing, this would be our assumption. You've got active management in the portfolio, which we would hope would add value. Tactically shifting the portfolio as potential fat pitches came across could help you also add value over those beta numbers. So you can think of these numbers as more of your benchmark, and they're just below that 6.5 target. But there's things that the portfolio can do to get to that 6.5 and potentially higher. So we don't necessarily build a portfolio to perfectly target a specific number, because again, we expect there to be a margin of error in all of these, and that's why it's always important to look at the distribution charts. We can pretty much say with certainty that over the next 10 years, you will not get exactly 6.43%, even if that's the median projection. So I wouldn't get too hung up on the idea that any one of these is falling a few basis points shy of that target, because we're expecting some imprecision.
Steve, just a general question. If I heard correctly, it indicated that about half of specialty credit is in fixed income.
Half of specialty credit is in public markets, high yield, levered loans, multi-sector. Yes.
Okay.
So if we looked at a 23% target to the specialty credit asset class, you know, we're 11.5% would be what we consider private credit.
I'm a conservative investor, and so I see 10-year treasuries at a good solid number, and looking at our liquidity, that we could guarantee a 4+% increase, return backed by the U.S. government. It just looks favorable to me. So I've just messed up an hour and a half conversation by floating that.
So how would this look if we took part of the specialty credit assets that are actually public investments and put them into core fixed income?
I guess that's what I said, Betty. Yeah.
They're not the same thing.
But we're not at 23, aren't we? At 20, 19 and a half?
19 and a half currently, yes.
Yeah, I think that would.
See, I like.
Okay, let me ask the question differently. I'm sorry, go ahead, Bill.
I don't feel like I can float an amendment against all the much more informed people than I am. I just like 13% core fixed income, the 3% from the specialty credit. We're staying at 45% public equity instead of going down to 40. That's just my bias, and it's uneducated. So I'm just telling you where I am. I'm ready to vote on something. So anybody want to make a motion?
Bill, would you want to?
Well, my confidence isn't there.
Can I make a suggestion? And I'll be happy to put it in the form of a motion. What I hear you telling me, Bill, is that you're not overly opposed to lower risk A, but you would like to see the numbers with that 3% adjustment to core fixed income. Is that correct?
Yes, that's where my bias is. Yes. I'm just concerned in how low that would bring the expected return in the calculation.
I'll make a motion that we make the recommendation to lower risk A to the full board, with the request that Wilshire give us the numbers with that. Instead of a lower risk B, we'll call it Bill's risk B.
Okay, I own it. It's all right.
And then, that way we at least narrow what we're looking at.
That's just changing 3% from specialty credit to core in essentially risk A? Is that the change?
I
Yes.
think that's correct, Bill.
I think that's correct, right?
We're happy to update the numbers.
Yeah.
Pretty confidently.
Risk A2.
It'll be pretty confident that
Really,
it's going to be a
just projections
marginal.
anyway. I don't think we can get down to decimal points.
Right. So still in that 640 ballpark with that.
Yeah, you've got a 250 basis points difference in the expected return of those two asset classes. So cuff it. You'll go down in risk a little bit and down in expected performance a little bit.
Is that a motion? Well,
That was my motion.
would you want to restate that? Make sure we have it correct, please.
I make the motion that we recommend back to the full board the lower risk A allocation, with the request that Wilshire provide us additional numbers with the 3% adjustment from specialty credit to core income.
All right. We have a motion. We're making progress. Is there a second to the motion?
I'll second.
Bill seconds. Now, any final discussion before we vote? If not, we'll proceed to vote. Would you please call the roll?
Yes, sir. Dr. Hackbart,
Yes.
Mr. Cheatham,
Yes.
Mr. O'Mara,
Yes.
and Ms. Pendergrass.
Yes.
I'm just noting Dr. Milkman is not in attendance. Thank you.
So the motion passes. So the recommendation will be forwarded to the full committee. full board, I should say. And I sincerely appreciate all the conversation and all the thought processes, discussion. I think we've taken this very seriously. We certainly appreciate the input we received from our consultant from Wilshire. That's very helpful, informative. And Steve and staff, we are very appreciative of the hard work that you've gone through. I think in this process, we've all learned a lot. I think you've been very forthcoming and really worked at this in some detail and been very responsive to all of our questions that we basically opposed, I think, and basically in the spirit of we're trying to do the best we can and to make the best recommendations and so forth as is our responsibility. So I'd like to thank all of you for your hard work and commitment to our deliberations and our efforts to carry out our responsibilities and to move forward. I think this does move this issue to the full board, and with possible additional adjustments and discussions there, I think we will be in a position to complete this process at the next meeting of the full CERS board. So thank you all. As far as I can tell, we have no other business. So would someone please move to adjourn the meeting?
Dr. Hackberg, just a couple of quick things on some material that we didn't go through. Just for personal requests. Page 111, the internal asset transaction report. Steve, if you don't mind, and Sherry, you two could probably have to together. Either if you're going to report that link, if you don't mind, make it a clickable link. I had a heck of a time to get it to I've got a couple of web page errors trying to put that in. Or if you can provide the report, and Sherry, you just put it in there as an addendum to the material, whichever one works best for you guys. And then the other one, and I made a note on, I think it had to do with private equity and the reports on calls and distributions and all that. Can you put a total at the bottom of those reports? You know, I think it'd be helpful for us to see what percentage we've got out there that's been called and what percentages have not been called. You just kind of got to go through it right now, line by line.
Sure, happy to do that. That's an easy change.
Good suggestion.
Is the link from board books the one that's difficult? Because I just clicked through on the PDF that I have of the document and it seems to load pretty. So I wasn't sure. Is that a board books thing or board
books? In board books, it's not clickable.
Okay.
You gotta, and you can't even highlight it and copy it and put it in anything. You got to type it in, and maybe it's my typing skills, but
well,
got a couple of 404 web page errors before I actually got where I needed to go.
Well, maybe it might be easier to provide the link in a different format for you. I'm just hesitant to include that report. Those reports are pretty lengthy, and I don't know if, we can do it either way, but if it's easier just to make sure that it's an accessible link, that might be the more efficient way to do it.
Whatever how you guys want to work it out, it's fine.
Okay, all right, perfect.
Those reports are always in the investments document, library document list. They're not hard to find on the website itself without putting in a link. You can go to the investments page and then the library, and then there's a long list of investment documents.
Mm-hmm.
So I'm not sure we need that link, because the library is updated very quick on a timely basis.
Does that cover it? Yeah. Okay.
That's all I had, Dr. Hackberg. Thank you.
Thank you. Appreciate that. With that, Would someone please move to adjourn the meeting?
Move to adjourn.
Second? All in favor, say aye.
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 Thank you all, and have a nice rest of the day, and hope we have a nice weather week. So thanks for everyone for really actively participating in discussion and helping us resolve this very important issue. So thank you. Bye now.
Thank you very much. Appreciate the time.
Thank you.